following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
And that very futuristic sounding theme means it's time once again for Volatility Views. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And my usual compatriot on the show here is taking a break, but we are joined instead by a regular on the program, Bob Kraus, the CEO of the Volatility Exchange. Bob, welcome back to the show.
Hi, Mark. Glad to be here. We've been very busy, and I'm very excited about our guest coming on, Nikunj Kapadia.
Yeah, that should be a fascinating discussion. I'm looking forward to it, discussing all manner of things related to volatility, as is our wont on this show. And we are also joined by the man from the pit, a.k.a. the Option Pit, good old Mark Sebastian from OptionPit.com. Mr. Seabass, welcome back to the program.
Oh, thank you very much. You know, I love when it's me and Bob Kraus. My only thing is, Don and I are about the same height, and Bob is a gargantuan 7'4". So, even from this far distance with him in New Jersey and me in Detroit, Michigan today, I feel towered over by the presence that is Bob Kraus.
Bob, it's amazing you can fit through doors, Bob.
Yeah, well, I'm not quite that big, but okay. I guess I look that big from somebody that's only 4 foot tall.
Exactly. See, Bob can play the game too there. I like it. All right. And with the team assembled, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we look at, or perhaps more accurately, look back at the volatility action over the past week. And it has been another interesting week in general volatility terms, with VIX selling off yet again, and then rallying back a wee bit, and then selling off yet again. And it's been just this general decline. And as we've discussed in recent shows, our earlier prediction that the new mean for VIX and for volatility was going to settle out somewhere around 23 to the 25 range has certainly proven incorrect. VIX has not looked back from that level in quite a while. So it has been an interesting time to watch. And we've debated on earlier shows, and I think we'll continue to debate on this show, exactly why people are still hitting vol at these levels, and quite aggressively so in many cases.
Well, Mark, look at the realized volatility.
Oh yeah, definitely.
VolX guys, they can tell you exactly why they're slamming volatility, right? Bob, what's realized vol look like right now?
Boy, I don't know. I haven't measured it lately. On the S&P, yeah, I can pull it up very easily. So,
Mark, we had the same conversation the other way, 3 months ago, and what was realized vol and what were people buying? It was still insane on that end. So they seem to have flipped heavily to the other direction. I certainly agree.
There's about a 10-point spread between the two right now.
I certainly agree. In a realized perspective, this is warranted, but it's been warranted to sell vol for months on a realized level.
I got the numbers. So here we go. The one vol for the S&P is 15.66. So that's the 1 month. The last 1 month was around 15, and the last 3 months is around 24. So VIX is at 22 now.
VIX cash is at 20.5 right now. So yeah, it's right in the middle of that range.
Still, 4 or 5 points above the realized volatility.
It seems as though the world has awakened to realize vol all at once. They were not cognizant of it at all until recently.
The VIX is at 22. You're looking at slow data. There's a 7.5 point premium. That's just wrong.
Well, normally it's 4, right? So we're about 3 points above that.
Here we go. 22. Yes. Yes. Okay. Yeah. I was looking at old data. I was looking at it. Okay.
Really, the VIX should be down at more like 19, if you think about it. And now, if you think VIX is overpriced, look at the VIX futures. Those are even more overpriced.
Yeah, they have settlement coming up, and they have a ways to come in yet, if you believe those numbers. Speaking of settlement, I think one of the largest and most significant developments to come around this week in terms of volatility was, of course, after us railing about it many, many times on this show, the CBOE has actually had a chance to put out an adjustment to their settlement process. And the circular just came out recently. I haven't had a chance to look it over. Have you had a chance to read it over, Mark?
No, I have not. I've not gotten a chance to look it over. And the other thing is the CBOE just listed this. Maybe it's this VIX EM stuff that is forced them to do that, because if you consider that the VIX EM trades in pennies, how easily is it going to be to mess with that settlement price in that product?
That's designed for manipulation at that point. So that'll be our homework.
That's part of the reason they're doing that, actually.
That'll be our homework for next week, and all of us have to dive into that circular and see exactly how they've adjusted the settlement, because it has been, quite frankly, borderline broken for quite a while. I think the final, a lot of people saying the last settlement period really was the straw that broke the camel's back. It was just so out of whack that they couldn't justify not adjusting their process any longer. And Bob, I know you kind of a last minute stand-in here for Don, but do you have any data you want to crunch here or to discuss looking back on Eurovol for the past week?
Well, let's see, the February contract settled at 11.33 yesterday, which, I guess looking at a volatility cone or whatever is about right. It's about average. The April contract, though, is still, up in the 13.3. So that's like at the 80th percentile. It's strange. It's interesting. The euro just keeps getting slammed. It's not collapsing. It's not creating huge vols, but it just keeps going down every day.
It's like those death by 1,000 cuts out there.
Yeah.
And Bob, this actually brings us back to kind of what volatility represents. The cause of volatility is not bad news. The cause of volatility is unexpected bad news. And, the market's ability to look at what's going on and digest it, and having digested it, that is why we're seeing this. The U.S. is moving away from sensitivity to the euro. With the euro down $1.50 last month, the S&P and a potential French down, and basically a confirmed French downgrade on the Wall Street Journal right now. You've got the euro down $1.50. A month ago, you see the S&P's down 25, 30 handles, and now we're looking at the S&P's are down $13, and I'll bet you bottom dollar, half of this is because we're going into a long weekend and everybody made money this week. So, there's not a lot of, our understanding of what is going on, I think has fundamentally changed, at least in the opinion of the market. And that is why we're seeing this slow death, this crawl down, as opposed to violent sell-off. And what's your guys' thoughts on that?
Yeah, well, you mean the crawl down on the euro? Yeah, the S&P has been, a mirror image of that, just slowly crawling up, and some of these financial stocks, like Bank of America and Citigroup and stuff. Bank of America is up like 40% or something.
Well, yeah, $1.50. But the thing is that a month ago, the euro down meant the market was down too, and S&Ps were down big, because there was a complete, dollar up, euro down, bad for S&P 500, and we're just not seeing that.
Yeah, there has been somewhat of a...
The only more confusing thing, if you want to get even more confusing than what's going on with the S&Ps, is follow West Texas and try and explain how that's operating. But because, this drop in the euro has really muted how much risk premium is priced in from the Straits of Hormuz. And now that it's apparent that somebody told the Iranians they're going to get bombed if they actually try and block it, they noticed that all the threats backed off. It's been kind of an interesting couple of days. But no, I mean, I know we're selling off today, but it's hard not to hate the euro and like the U.S. markets at the same time, which has not been something we've been able to do for several months.
Yeah, they're starting to decouple now. Hence, our I think we've just kind of become inured to the shocks here. We understand, like I said, we have a new understanding of what's going on. Or at least we think we do. I think we have a new understanding of what's going on in Europe every week.
Yep.
Well, my wife's always trying to decouple me, and it doesn't seem to be working
Hasn't
for her.
Hasn't worked out so far.
But
she needs a better lawyer.
Hopefully the U.S. does a better job.
Well, and that's one of the interesting things is, I think most people agree that these fixes in Europe are not a long-term solution and this and that, but does it give the U.S. banks the ability to kind of unwind some of those relationships with the European banks? If that's the case, that could really, that could smooth out a lot of things, and that could be part of the reason why Bank of America is rallying so hard.
You love your sub-$10 stocks.
I do.
Of course, they're not as fun as those 30-cent biotechs we always talk about on the odd block there.
Well, those are my favorite ones. Everybody knows I like a biotech worth $1.20, where somebody bought 90,000 of the $5 calls in July of 2013. Those are my plays.
That's Sebastian Paper right there. All right. And with that, we're going to close out the volatility review and dive right into our volatility viewpoint.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome. This is, of course, the portion of the show where we bring on a guest from some aspect, some area of the world of options and the world of volatility, and we take a few minutes to pick their brain on a variety of volatility-related subjects. And today's guest is Nikunj Kapadia. He is the associate professor. He's an associate professor over at the UMass Eisenberg School of Management. Nikunj, welcome to the program.
Hi, Mark. How are you? Good to be here.
And Nikunj, like we do with all of our first-time guests on the show, why don't we take a few minutes to have you give our audience a little bit of your background and how you decided to devote so much of your academic career to studying derivatives and volatility research?
Sure. So it happened accidentally, perhaps like most things. I was in India, and I had just finished working with my father in a family business. And I was just so exhausted and tired, I wanted to take a break. And I figured that if someone pays me to come on an expense-paid vacation in New York, I'll come here. So I applied for a PhD program to NYU, and they accepted me. And I ended up doing a PhD in finance. A few years later, I was talking to a professor of mine. My advisor was Steve Igluski, I think, who's been on your show before.
Yes, he was a guest a few weeks ago.
Yeah. So I was talking to another faculty member there called Yakov, and I was telling him I wasn't sure whether I should be in academia or not. And he said, well, if you're not sure, why don't you explore, working on Wall Street? So he called up a friend of his, and I went and joined the prop group of Bear Stearns. So the very next week, I ended up working in their options group. Now, they were doing prop trading, and it had a variety of instruments, but one of the major, trading desk was in options. And that got me fascinated by it because I kind of realized that a lot of the things which were happening in the market, what traders were doing, was not what the academic literature were looking at. So there I had my topic and my dissertation. And that's how I ended up on this.
Interesting. So it all started with your desire for a free vacation.
Exactly right.
It went downhill from there, maybe.
Oh, it wasn't a vacation at all.
That's interesting. We've had a lot of people on the shows talking about a lot of different reasons why they got interested in some aspect of derivatives or volatility, and that's the first time I've heard someone give us that reason. So that's a first. But you do indeed over there at UMass have stockpiled quite a bit of interesting research regarding different aspects of the derivatives markets, and in particular volatility, which is, of course, our purview here. So I think we'll just dive into some of your research, if you don't mind, and we can start talking about some of your interesting findings. Now, one of the topics we've discussed quite a bit on this show in the past is the relationship from implied volatility and realized volatility, and that premium that typically exists between implied versus realized. And you've done some interesting studies to that effect. And one of the recent studies you did, you've had a couple of interesting findings. First off, you confirmed that is indeed the case, that implied typically does have a premium to realized, both in index and in equity options. But you also found something interesting, that premium is typically higher in the indices than it is in the individual equity option. So why don't we dive into that a little bit and talk about some of your empirical findings on, first off, how you found it and confirmed that volatility premium does exist, and then we'll get into why you think that the levels are different between the indexes and the individual equity options.
Sure. So this kind of came directly from experience at Bear, right? Because if you go back to the early, maybe late 80s, early 90s, right? The idea was that options were kind of redundant securities, I mean, basically people bought options because they wanted a leverage position on the underlying. Yes. But once I was there, I saw that people were really using options to trade volatility. And if people were using options to trade volatility, there must be some kind of a reason why they're doing that. And nobody trades, something without having an underlying motive. And the way I kind of saw it was that there must be some kind of a risk premium attached to it. Okay, so that made me kind of go back and check whether or not. But the obvious thing to check was whether or not the implieds were different from realized. At that point in time, my advisor, Steve, had a paper where he had kind of investigated this issue, and he had found that the implied and realized didn't really match. So I want to take it a step further and ask what exactly was the difference. And it's very clear, after some of this investigation, that the implieds were consistently higher, and there were patterns over there, And the real question of understanding what the patterns were. Okay. Okay. Yes. So about what I thought it was. So here's the basic idea, right? We know that stock returns and volatilities are correlated, right? When the market falls, volatilities rise up, shoot up.
Typically.
Right? Yeah. So given that, if you were holding an index portfolio, say you had a long position in S&P 500, in that case, having options in a portfolio would help you kind of hedge some of that risk. Because if the market fell, the options in your position would, the vol part of it at least would go up.
Yes, the increase in volatility would offset some of the downside in the underlying.
That's exactly right? So that was the kind of logic of saying, let's go back and look at it as a possible risk premium, because people should then price this correlation into the option prices. And that's basically what I found, that for the index, there was a large difference between implied and the actual realized volatility. And the other patterns, like how the difference changes with the strike, all match what one expected. Okay. In comparison with the individual stocks, the difference is not that large. And that also kind of matches because it really is the market that people are worried about, when it comes to hedging risk.
So the paper flow in the indexes, then people are coming in to do even more. They're perhaps less or more concerned, I should say, with those dramatic swings and hedging out that dramatic risk than they are in perhaps some of the individual underlyings.
Yeah, exactly.
Which I suppose in some degrees is counterintuitive, because you would think the risk of going to zero is dramatically higher in any individual underlying than it is in the S&P 500.
That's correct. But that kind of goes back to, basically asking what is it that people use options for? And you probably have a better sense of this. But perhaps the people who trade individual options, equity options, are kind of have different motivations than those who trade index options. That's my basically take on it.
So what they're really trying to hedge is this systematic risk, really,
yes, exactly.
They're doing indices rather than, obviously stock-specific risk, but the systematic risk kind of pervades everything, not just stocks. So, maybe that brings in demand from other areas. That's
correct. And in fact, that's exactly right. So in fact, if you go back and look at the systematic portion of the risk in individual options, so if you look at an individual stock and say what part of the volatility comes from a systematic component, you find that the risk premium attached to the individual stock correlates with the systematic portion of the volatility. So what you said, Bob, is precisely correct.
So let's get into your paper now a little bit, because you took that as sort of the next step farther, which is determining or really analyzing the tail risk.
That's right. Mm-hmm.
So, explain your paper a little bit. What was the premise, and then roughly for our users, what is the conclusion?
Sure. So the way I came to it was trying to come back with a better volatility index. Now the problem with the VIX, the way it's constructed, is that it makes one very important assumption. And the assumption is that the stock price movements are continuous. In other words, they should not jump. There should not be discontinuities. Now, when there are fears of discontinuities, like during the financial crisis, during LTCM, the VIX underestimates the price of volatility. So the idea was that can I come back with a more accurate measure which takes into account this jump risk? And as I thought about it, I realized that once I have that better measure of volatility, the difference between that more accurate measure and the VIX basically gives you an idea of jump risk. And all of tail risk, the way we think of it, large extreme movements, are always caused by discontinuities or by jumps. So basically, I kind of had two things. Once I created a better volatility index, which is more accurate than the VIX in times of crisis, I automatically got a tail risk index.
Well, okay. let me
Sure.
back up for a second. So,
Sure.
what is it that you're comparing? You said you have the VIX,
right,
and then you're trying to measure or determine the jump risk that's incorporated or not incorporated into that value. How is it that you sort of isolated the jump risk factor from the VIX?
Okay, so that's a little bit complicated. Okay, so let me try and get it. So the VIX basically measures or trying to measure the price of the realized volatility in some sense. Where you square every return, just like Bob's contract, right? You square every return and you sum it up. On the other hand, there's a second way of measuring volatility, which is instead of squaring the daily return, I add the daily return over a period, 30 days or 90 days, and then I square it. So in one case, I'm doing the sum of the square of the returns. In a second case, you sum the returns first, and then you square it. So these are two different ways of measuring volatility. It turns out that we do not have a model-free way of pricing the first one, that is the sum of the return squares. However, in an earlier paper of mine with Gurdeep Bakshi and Dilip Madan, we had showed how to correctly price in a model-free manner without making any assumption of what the underlying process is. And we can price the variance of the holding period return. That is, if I compute the log return over a period and I square it, okay, I can precisely figure out the price of that. And because I can precisely figure out the price of that, it takes into account jump risk also, while the VIX does not. Okay.
So you found essentially that the tail risk is being somewhat inaccurately measured right now, not just in the VIX, but in a lot of general index products as well out there. You feel that if you can properly model the tail risk, then you shouldn't be seeing these inflated levels of premium in these far out of the money puts, let's say, for example. It should be modeled much more accurately through the overall levels of volatility. Was that your conclusion?
Yeah, so effectively, basically, when you take into account these options to construct the VIX kind of underestimates the true volatility, the true price of volatility. It's not that much. It really is only significant in times of crisis. So there are two periods when the VIX significantly underestimates the price of volatility. That's on the LTCM and in the current, 2008 onwards.
And those numbers, if I recall from your study, were relatively significant. I think they were at least 12%, if not higher, in certain scenarios, correct?
Yeah, that's right. 12% on a variance basis and about 5% if you think in terms of volatility. So if we take the square of the variance at 12%, volatility is 5%. So basically, if you're pricing it wrongly, you would end up losing money. That's basically it.
So I think a lot of these options traders right now who are out there running Black-Scholes models, and they're incorporating all these vast levels of inflated levels of premium into, let's say, the far out of the money puts in the S&P 500, incorporating that physical level of tail risk. Do you think they're modeling it wrong? They should be reducing that level of far out of the money premium and perhaps more accurately modeling the level of ATM volatility?
Well, actually, so this measure takes into account the prices of out of the money puts. So I cannot really answer that question because just like the VIX is constructed, the current VIX is constructed from a portfolio of all the options. Similarly, what I construct also is also constructed of a portfolio of all the options, including the OTM options. So in some sense, I basically incorporate whatever the market is pricing these puts at. So if the market is pricing the puts wrong, then the measures of VIX and volatility and tail risk are also wrong. So effectively, what I'm measuring is basically what the market is saying. I'm just trying to infer out in a systematic manner what is it that the market is telling us right now. So it doesn't really tell us the physical part of a tail risk. It only tells us what the market, how the market is pricing the tail risk in these OTM options.
Okay, Nikunj, there's one thing. I have a question for you, but there's one thing I'm still not clear on. So sure. in the 32,000 foot view of this, yep. We've determined that generally, implied volatilities are too high. In other words, they're over-guessing, if you will, the subsequent realized volatility. But right. But then, this tail research, says that during times of crisis, then the VIX is too low, right?
That's correct, but that's only because it doesn't correctly price, the true price of volatility.
Okay, but how do you get from? Generally, in times of crisis, they come from out of nowhere. If everybody knew it was coming, then they would all know how to price options and start selling stocks or whatever ahead of time. But sure. So there's this big event coming up that nobody seems to know about. How can you sort of pre-price that in and then tell everybody, well, generally it's already too expensive, so to add in more just seems kind of strange or ridiculous.
Yeah, that's correct. You cannot. So we cannot price in anything which is unexpected. That's correct. Okay. It only comes in if the option prices are impacted. So if you look at the construction of the VIX, leaving aside what I'm doing, the VIX basically takes the prices of all the options, puts a weight to it, and then adds them all up to come up with a VIX. If the option price doesn't anticipate that shock which is coming, it will not be incorporated into the VIX.
Right.
So my point is that, however, you got to have the weights which are correct. So when you create the portfolio of options, the weight you put on each option has to be correctly put. What the VIX does is it puts too little a weight on the deep out of the money puts. It actually puts a symmetric weight, so that's the problem. So once you make the right adjustment, you put a slightly higher weight on the OTM puts. Because of negative correlation, it's more likely that the market will go down and go up by a big amount. And that makes the adjustment for the jumps, the large jumps. Okay. However, going back to Bob's point, if the option market doesn't anticipate an event, it will not be incorporated into the index. And it can only incorporate what the option markets are incorporating. And if the option markets are wrong, then the indexes are wrong.
Well, we've certainly had many discussions on this program about the way options in general and the VIX in particular put some inflated levels of premium, I think you could say, on those out-of-the-money puts,
correct.
which is why I brought those up earlier, because that is such an interesting, and that's such a physical manifestation of tail risk. You know, we talk about tail risk in all these different forms and all these different models and all these various theoretical manifestations, but there's a physical embodiment of tail risk when all you have to do is look at the S&P put wing, and you can see it right there made manifest right in front of you, which is why I asked that earlier. But you mentioned...
Yeah, that's absolutely right.
And your some of your findings in your study also found that not just is the VIX incorrectly modeling this risk in times of great crisis, but you're also saying in general markets like variance swaps are essentially doing it wrong as well, correct?
Yeah, that's correct, because variance swaps are basically using a similar pricing formula as the VIX. So if we're using a similar pricing formula, and that's because nobody knew how to do this, right? So if you were using the VIX type of formula to price a variance swap, you would have ended up losing money during the financial crisis. You would find that the price you were paying was too little compared to what actually manifested. But if you kind of adjust for it correctly, then you would end up losing less, basically. I mean, you cannot anticipate what happened, but at least you would lose less than what you would lose if you were using the VIX methodology to price a variance swap.
So, Nikunj, let me just make sure I understand then. What your research is saying is that the VIX is weighting these out-of-the-money puts and putting too little weight or too much weight in those out-of-the-money puts?
Too little weight.
Too little weight. So,
right.
So it should be even more, which is in a way, I don't know, kind of strange to me, because
yeah, it's kind of counterintuitive at first.
They can be 30, 50, 70, sometimes 100% volatility, as you go farther and further out. And
right.
And the weighting based on this, on the formula actually gets a little bit more, it seems like it gets more pronounced, especially when you compare it to the out-of-the-money calls.
That's correct. So that's exactly what happens. But however, the much of the impact comes for the near money. And the reason is that you're adding up the prices. And as we go out of the money, the prices of the puts falls quite rapidly. Okay, so the extra weight really matters close to the money, maybe about 5 or 7% out. Okay, that really starts making a difference, because when it goes very far OTM, the prices is basically so low, it doesn't really matter that much. So it's more the 5 to 10% which are more highly weighted.
That's interesting.
Compared to the VIX.
In fact, there was another paper. Do you remember what it was, Mark? I don't know. It was about 10 shows ago. We mentioned it. There was another paper that basically said that the price of the out-of-the-money options were indeed too cheap.
Yeah, I'm trying to remember the author and the name of it right now. It escapes me at the top of my head. I'll have to search through the show notes after we record and see if I could find it. But
that was interesting, because as the market went up, then the out-of-the-money calls were too expensive. At least in that paper was. And I don't know how much you looked at the out-of-the-money calls, the tail risk on the upside, but.
Yeah, no, I haven't looked into the. Well, when I think of tail risk, I typically think of tail risk on downside. So, but someone asked me this question. I haven't gotten around to looking at the tail risks separately. So it's a good point, actually. I should probably go back and check it out.
Yeah, you're right. They found that there was an error in the way it was, or just a poor calculation to the upside on the call wing. And yeah, tail risk is often forgotten to the upside. It's not really, people don't think much, and look in the market, they don't price much in the way of volatility premium into those upside calls, predominantly because the majority of the paper flow in that call wing is people coming in and writing covered calls in orders of magnitude in any large equity option. So that tends to depress those volatility levels as well. But yeah, that's an interesting finding. I think a lot of our listeners will find it initially counterintuitive to think of those out-of-the-money puts, which are traditionally thought of as being so overinflated and overpriced, to indeed not be factored in correctly and not factored in enough with enough premium in the VIX. But then I think your point about it being the near term, the near out of the money puts, that seems to make a little bit more sense in that regard.
That's right. So we're not talking about really the ones which are crazily priced with 100% implied and all that, because the prices of those are very small anyway. They don't really add much to the computations.
So have you done much else with this tail risk model that you've created? Have you tried to apply it to other methods? Have you looked to license products on it? Have you continued to update it? Now that you have this perfect encapsulation of tail risk, what have you done with it going forward?
Well, so I should really go back and try and create a product out of it. But right now it's been mostly academic. So the first thing I thought of was really asking whether or not equity returns react to what the option markets are pricing. So whether we can collect this information of tail risk from options, and does it predict future returns? Now, recent research has actually shown that the variance risk premium, right, the difference between the implied and the realized, actually predicts 6 month ahead returns. And it's one of the strongest predictor of future returns, 3 to 6 months ahead, more than other things that people have found like dividend yield and price earnings ratio. So I really want to go back and check whether or not tail risk also helps to predict future returns along with the volatility risk premium. And my most recent research, which is not in this paper, actually shows that it does help. It does help along with the variance risk premium. So the variance risk premium along with tail risk both helped to predict about 3 months to 9 months ahead future returns. Of course, the predictability is very low. It's not like you can really make money on it, but it's still interesting to find that what's happening in the options markets has some bearing or takes into account some fears of what's likely to happen, and the expectations are such that you actually see some evidence of it being correctly taken into account in option prices.
That sounds really, really interesting. I can't wait to get you back on the show after you write that one.
Sure.
Yes, Nikunj, we are running a little bit low on time here for this segment, but you mentioned some of your upcoming research. Is there anything else you have in the works, or anything else you might want to plug, upcoming papers, upcoming publications that you think will interest our audience?
Well, I think this is the main one. I'm planning actually a number of applications of this, so keep a lookout for tail risk. The other stuff is things which the audience probably heard of. So I have a couple of papers with my PhD students on the buy-right strategies, and that's been around. So that's the Option Industry Council has it prominently displayed on the website.
Yes, I'm very familiar with those. We do a lot of work with the OIC here, and we love all the stuff you guys do over at UMass on the buy rights, on the collars. There's been a lot of great studies coming out on those. In fact, I guess we have a couple minutes. I can ask you about those really quickly because those are very fascinating. Have you been active in the collar ones as well, or primarily the buy rights?
No, primarily the buy rights.
And I guess really quickly for our listeners who haven't read those studies, and they are prominently displayed on the OIC site, we've discussed them on the Options Insider as well. What were some of your main takeaways from the buy right study?
Okay, so the main thing is when you buy right, you always worry about the upside, right? What if the market runs away from you, right?
Yes.
And we actually find that when you go back and implement it, right, you pick up a lot of the returns. Even in the worst possible scenario, when in the mid-2000s, when the market was going almost straight line up, okay, even there, your Sharpe ratios were very, very, very reasonable. So overall, it seems to work, pretty well.
Yeah, seems like the predominant finding across a lot of the studies coming out of UMass, whether it's the collars or the buy rights, that even on those scenarios like you mentioned where you're worried about clipping your upside with these strategies, even when they're writing at the money calls, which I found even surprising, the overall returns are competitive to just owning the underlying, and on a volatility adjusted basis, they're orders of magnitude better.
That's right. Yeah.
So that is,
and I haven't done this, but with the weeklies, I think it's going to be even better. Because weeklies have so much premium on it, I think it's going to be extremely profitable to trade the weeklies.
So are you thinking about adjusting the buy right study to incorporate weeklies as well?
Yeah, we've been thinking about that, and we're talking to the OIC. Well, I've been trading it myself, so we haven't actually gotten around to doing a study because the historical period is not very large. We only had a couple of years now, right?
Yeah.
But at some point, once we have at least 3 years of data, we'll go back and look at the weeklies.
Well, that'll be another fascinating study I'm looking forward to. So, Nikunj, you need to get off this show and go back to your research so we can have more studies, no studies to talk about in future episodes. But we want to definitely thank you very much for coming on the show. And if any of our listeners want to find your research, it is all available at UMass. Just go to umass.edu and search for Nikunj Kapadia. That's Nikunj Kapadia. And you'll find PDFs of most of your papers up there. And I assure you it is fascinating reading if you're into volatility, and I'm assuming if you're listening to this show, then you probably are. But thanks again, Nikunj. We'll have to bring you on again down the road.
Thank you, Mark. Thank you, Bob.
Bye, Nikunj. Thank you.
And that's going to do it for our Volatility Viewpoint, and now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
And those pleasant, calming notes mean it's time once again for the Crystal Ball segment. This is, of course, the portion of the show where we peer into the murky ether of the future and try to divine what will happen in the world of volatility. And now that my volatility numbers are updating correctly, it'll be an easier process. I guess I was looking at 2-day-old data there or something there. It looked kind of familiar, but it's strangely odd at the same time. But yes, there has been a lot of interesting things going on. Of course, the VIX has been revamped, so we're all going to dive into that going forward. But the question right these days, as it is many days, is whither the VIX. So, Mr. Sebastian, I shall put that question to you first. Whither the VIX over the coming week?
Oh, Mark. I think the fact that, as I was saying earlier, we now know that S&P is going to downgrade France and a bunch of other things. That news is out there, and the S&Ps are not reacting. I think that points, and really, this is actually the most volatile day we've had in about 2 weeks, and we're down 1%, which points toward a VIX of 15. So I like the VIX heading to 19, and I like heavy pressure on both VIX futures in Jan and Feb. And keep an eye on that Feb-March roll. That is super steep right now relative to the rest of the curve. So, there's a lot of stuff I don't like. But I think even if you think the market is going to explode, coming up with an S&P versus VIX approach would make the most sense.
Yeah, if you buy what the futures are selling right now, then the VIX still has a way to go before it to the downside before it finds its equilibrium point there. Yeah. And I tend to buy what the futures are selling usually. And then, of course, Bob, we also cover the broad purview of volatility and volatility products here on Volatility Views, and that includes, of course, the Euro VolContracts. And this is the portion of the show where Don usually gives us some outlandish and crazy prediction for what's coming up in terms of Euro Vol. And Bob, you are welcome to follow suit if you feel up to the challenge.
Okay, I predict it's going up.
There we go, and that's going to do it for this episode of Volatility Views.
Well, Don's always the big seller, so I figured I'd just take the other side.
Yeah, Don is not a big fan of buying the premium these days, or buying much of anything. Has he ever owned anything in a retirement account or anything along those lines?
He is a buy and hold indexer. He just buys the S&P and holds forever.
I wasn't sure if he was just short everything.
No, I don't think he's ever shorted a thing in his life, other than options trading or whatever. But as far as regular investing, he just buy and hold S&P forever, which is really the only kind of buy and hold I've ever that I know. Really, a lot of people say that they're buy and hold, but then they tell you whatever that I don't like the thing in Europe, and I think Japan is coming around, or all of those kind of predictions, which then you're not a buy and hold kind of person. A buy and hold is thick and thin, no matter what. You're long.
Next time he's on the show, I'll have to call him Don Buy and Hold Schlesinger. We'll see how he reacts to that, because I usually call him a degenerate premium seller on the show, and now I'll have to change my tune. Apparently, he's a degenerate buyer.
And
yeah.
he thinks I'm a degenerate seller all the time. I like playing the short side of things, And,
would you call it degenerate buy and sold to you? Is that the way you do it with Don?
Yeah, basically. I find the current S&P market just very fascinating, with a lot of, macro risks out there. It just keeps plugging higher, which to me, there's two ways of looking at that. Is it overextended and just waiting for a fall, or is it kind of being held back like a racehorse that you don't want to, let the reins out? But to me, it feels like, this is a racehorse situation where the lid is just kept on to a very strong domestic rebound here.
That just plays into what we were speaking about with our guest in the last segment about how no one has really applied the same level of analysis to upside tail risk and to the upside tail in general. Everyone is focused on the quote-unquote proverbial Black Swan event and the out-of-the-money put premium, and that's where all the studies and all of the mental resources have been spent over the past few years. But like we discussed, no one's really looking at the upside calls, the upside tail, and perhaps properly analyzing them and see if they are properly modeled for perhaps if you're right, Bob, and the lid does explode off to the upside, an explosion to the upside, an upside crash, if you will.
Yeah, well, I don't know if I'd go on the record kind of predicting that.
It's too late. It's already out there.
Underlying fundamental positives that the market is slowly being convinced of, and just keeps plugging, keep going up regardless of any of the bad news that comes out.
The title of this show will be Bob Kraus, CEO of VolX, predicts explosion to the upside in near term.
I knew you guys would misquote me.
Remember when I was back out in the SPX, we did have some times where there were, quote unquote crashes to the upside. A lot of that was, and the implosions or the explosions in vol, we did recede to the upside because the crashes continue. And a lot of that was paper driven. We were all short to the upside, so we had to just bid up vol out of control to get that vol back. But so there are scenarios where that does happen. It is ridiculously infrequent, but it can happen. I would like to see some paper on that at least, or at the very least some paper that puts equal weight to the call wing and the put wing, and see in terms of analysis. But Mark, you missed a good one. You'll have to listen to the show so you can hear that conversation we had earlier. But that is going to do it for this episode of Volatility Views. I want to thank our guest, Nikunj Kapadia, and again, you could find all of his work over at UMass.edu, and there's a lot of interesting papers up there, and you can read the full papers, not just the abstract, which I always find interesting. And I also want to thank Bob and Mark for joining me on the show here today. Mark, I believe you have an upcoming webinar you might want to let the folks know about.
Yeah, we're doing when not to use the VIX as a trading indicator. And that's this coming Wednesday. It's going to be me and Andrew. It's going to be in our series of monthly volatility presentations. So once these guys, and I can promise you this, we're probably going to hit something maybe VX EM next month, and then at some point, my plan is to trade to do a long presentation on a realized volatility equity product. Not sure when and where I'll get to do that, but I'm looking forward to doing something on that.
Well, you're on the same boat that I am here, because I was just going to toss it to Bob and see if he had any further teases for our audience on exactly what you guys have cooking over there at VolX.
Well, we didn't come out with a formal press announcement, but we put the final signatures on an agreement with the NASDAQ. So it looks like we're going to have volatility on the NASDAQ 100 coming out soon.
Oh, wow. I didn't know you had announced it. We buried the lead. This should have been at the top of the show.
That's awesome.
That is fantastic.
Yeah, I wanted it buried in the back so that, we made our listeners listen to the whole thing.
All right, and listeners have been excited about that, and we've got a lot of emails.
I'm super excited about this. This is unbelievable. I can't wait to trade that.
Ever since the show started, people have been asking for something aside from the euro for a variety of reasons. They're not euro guys, they're not currency guys, they're not futures guys. So the fact that the NASDAQ is coming is enormous, and I believe you also have plans down the road for options as well, correct?
Yes, we'd actually like to. We're working on the whole suite, so try to get what we call VolContracts, right? Realized volatility futures, And then we'd like to try and get, NASDAQ owns their own exchange in Philadelphia. So it might be a little bit easier to get a listing of options on volatility there. And who knows, maybe we can convince one of these investment banks to roll out an ETN or something like that.
Well, Bob, that is enormous news. I know a lot of our listeners will be very excited to hear more details on that, and it's something they've been bugging us for ever since we launched this show. So I'm glad we can finally offer them something to answer all of those questions we've been getting, let alone you. So with that enormous news, we're going to close out this episode of Volatility Views, and we'll see you back here next week.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.